Hi, everyone. Thanks for joining us for today's webinar. We're going to begin. It's titled The Affordable Care Act, Tax Update for Nonprofits. If you're attending this webinar for CE credit, please note that if you meet the requirements, which I'll go over in a moment, that you'll receive an email within 3 business days to access your certificate of completion. So now, just a few housekeeping items. Using your webinar pane, if you'd like to go maximize or minimize the pane during the presentation, use the red arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a chat box that you can use to enter your questions. Just type in your questions, click submit, and we'll get to them as soon as we can, either during the webinar or at the end. Our presenters will answer those questions as time allows. So managing your audio settings. If you're using a telephone, please click the telephone audio mode. If you're listening through your computer, then please click the mic and speakers option. Now I'd like to give you a quick overview of CE credit requirements. You must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. There will be 4, which means you have to answer 3. And you must complete the evaluation survey at the end of the webinar. Now a quick overview of our learning objectives. We're going to review ACA changes and updated requirements from the past 6 months, discuss the transitional relief criteria to extend compliance requirements for large and mid-sized employers. We're going to identify simplified reporting options available, and we're going to recognize what you should be doing now to ensure your nonprofit is in compliance. Quickly, I'll give you an introduction to our presenters today. First off is Dan Jones, tax partner with Armanino. He has more than 20 years of experience. He helps clients understand complicated tax issues such as ACA, and he also identifies the best strategies to plan and take advantage of tax benefits. He's a graduate of the University of California at Santa Barbara. Our second presenter is Susan Miller. She has a Juris Doctorate, and she's a manager with Armanino. She has more than 10 years of experience building relationships with finance professionals and nonprofits. She stays up to date on all new ACA compliance requirements and is passionate about finding solutions to meet client needs. She received her undergraduate degree from the University of Massachusetts in Boston. And with that, I'll turn it over to Susan for the presentation overview.
Thank you so much, Debbie. Thank you, everyone, so much for joining our presentation today. On today's webinar, we are going to review a brief history of the Affordable Care Act and quickly mention where we started and how we all got to where we are today. We will discuss transitional relief for both mid-size and large employers and show you how to calculate your employee headcount. Additionally, we're going to walk you through the reporting requirements that were outlined in the final regulations that came out earlier this year. And finally, we're going to talk to you about next steps. Before we move forward, though, I'm going to turn it back over to Debbie for our very first polling question.
Thanks, Susan. So as a reminder, as I just said, for CE credit, you'll have to respond to 75% of the questions. We have 4, and this is our first one. So what date did President Obama sign into law the Patient Protection and Affordable Care Act? Was it A, June 2nd, 2013, B, March 23rd, 2010, C, June 28th, 2012, or D, not sure? Give you a couple more seconds to finish adding in your answer, and we'll close the polls in 3, 2, and 1. And I'll turn it back over to Susan to review the results.
Okay, so it looks like several of you got the answer correct. It is March 23rd, 2010. If you recall, President Obama signed the Patient Protection and Affordable Care Act into law on March 23rd, 2010. Thereafter, also, if you recall, there was a lot of debates and appeals, and the Affordable Care Act went up to the Supreme Court on June 28th. And if you were watching the news, as I was, you saw reporters come out and you saw them start reporting that the Affordable Care Act had been struck down. That was true. It had been struck down under the Commerce Clause, but they had to recant and come back and say, but wait a minute, it was upheld, and it was held under Congress's right to tax its citizens. So it was upheld under a taxing clause. Since it was ruled a tax, the mandate fell into the lap of the IRS and then subsequently into ours. And so this is how CBAs got involved in the process. And so here we all are today. There was obviously a high amount of stress and confusion for employers, and there is actually still to this day. Dan and I get a lot of emails, a lot of phone calls. We have a lot of people asking us to come in and give these presentations because a lot of people are still confused about the rules and the regs that came down. The White House listened last year, and if you recall, on the 4th of July weekend, right before it, they posted a blog, and they announced that there was a 1-year delay in the requirement that large businesses must provide workers with affordable health care. And so they moved the start date for employers to January 1st, 2015. The Treasury Department agreed that the delay was legally sound and is a form of transitional relief, and the IRS has conceded. So here we all are. So employers did receive the delay. However, the individual mandate has already started. It began this year, January 1st. So individuals are required to obtain basic health insurance coverage or pay a nominal tax penalty. And so, Dan, I believe the tax penalty is $95 for each individual, or 1% of their income, whichever is higher. Is that correct?
Yeah, that's absolutely correct. So it's pretty small phase-in penalties, so it won't hurt too many people.
Yeah. So just to put everything into perspective, before the Affordable Care Act took effect, it was reported that there were about 44 million Americans who did not have health care coverage. Out of this group, there are now approximately 8 million that have health insurance, and 5.5 have it through the federal exchange, and 1.4 million are enrolled through Covered California. And if you break that down a little bit further, 28% are ages 18 to 34, and 33% are ages 55 to 64. Okay, so moving forward, on February 10th of this year, the Treasury Department released most of the long-awaited final regulations. Of note, they identified the midsize employer group, which they had not done until this year. Midsize employers are those employers who have at least 50, but no more than 99 full-time and full-time equivalents. As mentioned, large employers, those who have 100 or more full-time equivalent employees, must be in compliance with the Affordable Care Act as of January 1st, 2015, which is in just about 6 months from now. So it's pretty soon. However, the mid-size employer group, again 50 to 99 employees, has been granted an additional 1 year to comply. Thus, compliance is not required until January 1st, 2016. However, mid-size employers need to qualify for this transitional relief and delay until 2016. And we are going to cover it today on today's webinar. Okay, so we're going to focus on this. I was a bit frustrated that this component has not been as publicized as I think that it should be, because this is super important for anyone who is a mid-size employer, again, 50 to 99 full-times, because you have to do something this year to qualify for the relief, for the transitional relief. So out of the entire presentation, if you hang on to anything that we speak on, this piece right here is the super important piece. And I would even suggest to print the slide out and hang it up so you can always reference it. So under the final regs, eligible mid-size employers will not be subject to the pay or play tax penalties until 2016, as long as you meet the following requirements during 2014. So you must employ on average fewer than 100 full-time employees plus full-time equivalents during 2014. You must maintain your workforce size and aggregate hours of service, meaning the employer may not reduce its workforce or overall hours of employee service to qualify.
Let me chime in there.
Sure.
There are some situations where you can actually reduce your work size force, and that's for changes in business, changes in your industry, or you're just not doing that well and you can't afford to have those employees. What they're really getting at there is that they don't want you changing your employee workforce size just to qualify for this mid-size transitional period. So if you actually have legitimate reasons for it, you'll just need to document those and be able to prove that you did indeed have a reason for reducing that workforce.
Exactly. Next, you need to maintain the health care coverage you offered as of February 9th of this year. And then you have to certify that your company meets these information reporting requirements, and that will be on Form 1094C.
Yeah, so it's just essentially the IRS do not want you changing what you're doing now just to comply with the 50 to 99 mid-size transitional rules. So as long as you're not doing that, you're going to be fine and qualify for the 1-year delay.
So basically you're going to stay the course of what you're already doing, but of note, and what is important here, is you do need to fill out a certification. You do need to certify all of this and submit it to the IRS. So please remember, even if your company meets the mid-size employer requirements for certification, it will still be subject to the Affordable Care Act's large employer information reporting requirements under IRC Section 6056 in 2015. Additionally, the IRS is yet to issue all of the final forms on information reporting requirements. Once the final forms are released, we will be sure to keep you informed. And we usually do this through our tax alerts, so if you haven't signed up for those, please do. It looks like it's time for another polling question, Debbie. I'm going to turn it back to you.
Thanks, Susan. So as a quick transition into large employer requirements, hopefully we'll see if you know the answer to this. So in 2015, large employers, which are those with 100 or more full-time employees or equivalents, are required to provide minimum essential coverage to what percentage of employees? Is the answer A, 50%, B, 65%, C, 70%, D, 95%, or E, 100%? We'll give you a few more seconds to answer. We'll close the polls in 3, 2, and 1. And I'll turn it back over to Dan to review the results.
All right, that's kind of it looks like a tricky question for everyone. The answer is 70%. So what that means is that, and we'll go over this, the offer of coverage has to be to at least 70% of your full-time employees. And that's under this transitional relief. So let's talk about the transitional relief for large employers. So the very first piece of transitional relief was in determining whether you're a large employer or not. Originally, a large employer was considered 50 or more full-time employees and full-time equivalents. But under the transitional relief, they moved that up to 100 plus employees. So there, a lot less people are going to fall under the mandate for 2015. And there's a couple components to this mandate. So what Congress, the president wanted to have happen was that people would have access to health care that is affordable and provides at least a minimum benefit under their coverage. So the first piece is just offering insurance. So for a large employer, you need to offer insurance to all your full-time employees and their dependents. Note here, full-time employees are people who work 30 or more hours per week on average. And dependents in this case are only considered your dependent children under 26 years of age. So your spouse does not fall as a dependent in this case. So the employers do not have to offer coverage to their employees' spouses. Now, what the IRS wanted to have happen in Congress was if you're trying to comply, they didn't want to stick it to you. So they gave you these safe harbors of a percentage for offering insurance. So in 2015, under this transitional relief, as we talked about in the poll, that is 70%. So out of if you had 100 employees, if you offered coverage to at least 70 of them, you'd be in compliance under this piece. Note that in 2016, that offer is going to go back up to 95%, and large employers at that point are going to be considered 50 or more employees. So that's one piece, offering a coverage. Now what is the other piece to that? Let's talk about whether it's affordable or you've provided at least a certain amount of minimum essential coverage. So the next piece is it affordable? And how do you determine whether or not it's affordable? Under the law, affordability is based on your family's income, but as an employer, you don't necessarily know what that family income is going to be. So there's a safe harbor that you can use to make sure that you're offering affordable coverage. And that is 9.5% of your employee's income. And we'll go a little bit more into detail on that. The other piece is that it's got to provide minimum value benefits, just meaning you can't offer insurance that, say, only covers pregnancies, something like that. If you don't, then you could be subject to penalties, which we'll also go into a little bit later. So let's talk about affordability, safe harbor. So as I said before, the safe harbor is going to be based on your employee's W-2. The reason they use that is because you know what that is. You have access to that. You're paying them. You have to report their wages, so you know what that is. And so what it is it's 9.5% of their W-2. As long as you offer coverage that they don't have to pay more than that per month, and you are considered to be affordable. There's some situations where people get commissions or they're salary based, and there's another safe harbor that they've written in, and it's called rate of pay. So you can actually use the rate of pay to determine whether or not you're meeting the safe harbor number. And that's really useful, like I said, if you have paid by commissions or give bonuses. And then finally, the last safe harbor is you can base it on the federal poverty line. So as the very minimum amount, as long as you multiply 9.5% times the federal poverty line and offer that to employees, that's going to be considered affordable. Now what happens if you are subject to the mandate and you don't offer coverage or it's not affordable? Well, you have potential penalties. So let's talk about that a little bit. So like I said, there's two sets of penalties. One, for not offering the coverage to your full-time employees and their dependents. And the second penalty is based on if it's not affordable or doesn't meet that minimum value. One thing to note on the minimum value is that that's something that's an actuarial calculation, so you won't, as an employer, be able to determine that. You'll have to rely on your insurance carrier for that. And finally, none of these penalties are going to take place unless you have employees that actually decline your coverage and they go on to the marketplace, which is where you can buy governmental sponsored insurance. And not only do they buy it from there, but they qualify for one of the subsidies that if you're a low income person. At that point, you could get hit with penalties, which as you can see are $2,000 and $3,000. And they're now going to be indexed for inflation. Before we go through an example, let's ask polling question number 3.
Thank you, Dan. So our third polling question out of 4, so if you've missed one, definitely answer this one. Employers do not need to offer coverage to which of the following employees? So an employee who consistently works 40 hours a week, B, an employee who works 35 hours a week, C, an employee who works 20 hours a week, or D, not sure. And as a reminder for those of you who would like to view these slides after the presentation, I'll be sending around an email with the slides, so yes, they will be available after the webinar. And we'll close the polls here in a few seconds. We'll close the polls in 3, 2, and 1. And I'll turn it back over to Dan.
All right. Now that was a question that everyone could get. Yes, the correct answer is C, 20 hours a week. As you recall, to be considered a full-time employee is based on 30 hours a week. So let's go through some penalty examples. First, let's talk about penalty for not offering insurance. And there was some transitional relief here that I will point out. So our first example here is that, as you recall, being a large employer is 100 or more full-time employees and their equivalent. So here we are. You have 100 full-time employees, and unfortunately, you didn't offer insurance to at least 70% of them. And to boot, one of your employees, since they didn't get insurance from you, went onto the exchange, purchased their insurance there, and they qualified for one of the federal subsidies. Unfortunately, because of that, you're now going to get penalized. So first thing you do is under transitional relief, you get to subtract 80 from those full-time employees. So now we're at 20 full-time employees, and that is what we're going to be subject to the penalty on. So you can see there the penalty in this case is $2,000 per employee, or $40,000 for the year. Now that is going to be billed monthly, and so that monthly penalty would be $3,333 per month, and it's not tax deductible, which for nonprofits isn't such a big deal unless potentially you are subject to unrelated business tax. So it could impact you there, but certainly the penalty does.
And the penalty increases with inflation, and so it could go up. So that's something to think about.
So yeah, and you can see here that you could have offered 69 of your employees coverage. So you're paying for coverage for them, but because you didn't meet the 70%, you're going to get penalized on the entire workforce. So not only do you pay the penalty on the entire workforce, but you also pay insurance for the employees that you actually are paying insurance for. So this is the one piece, if you're a large employer, that you don't want to fall afoul of, because you can see that it could add up pretty fast. And you'll see in 2016, when this transitional relief goes away, that 80 subtraction is going to go down. And we'll talk about that a little later. All right, so piece number 2 is it affordable? Or does it meet the minimum benefits that make it actually useful insurance? So let's say you've qualified for the offering the insurance. Well, what if it's not affordable? And let me point out one thing that people may not realize either, that affordability is only for your employees. It does not have to be affordable to their dependents. So the affordability clause is only for the full-time employees that you have. All right. So your insurance is not affordable. We use the same 100 full-time employees, and because it's not affordable, 25 of your employees go to the exchange and they receive a subsidy. So you're going to get penalized on them. So this penalty is $3,000 per employee, or in this case, $75,000. which once again, it's a monthly penalty. That's going to be $6,250. And like I said before, it's not tax deductible, which may or may not impact a lot of you.
And it does go up with inflation as well.
Now, there is a caveat, and this is where the transitional relief, especially in this example, really helps you. The penalty for not offering affordable or minimum value is going to be capped at the penalty to the same penalty that you would have had you not offered insurance altogether. So as you recall, our penalty for not offering insurance in this example was $40,000. Well, that's less than the penalty for not offering the affordable coverage. So your penalty would not have been $75,000 in this case, but it'd be capped at $40,000, which in this case is a good benefit for the transitional relief, because once the transitional relief goes away, where we talked about you get to subtract 80 employees to calculate the penalty for not offering insurance. Well, in 2016, that goes to 30 employee subtraction. So in that case, we would add 100 employees less 30, which would mean 70 employees are going to be subject to the penalty. That would have been $140,000, which is more than the penalty you would have had for not offering the affordable, which was the 75. So you can see there it's a $35,000 difference in this case. So you would have saved $35,000 under the transitional relief. All right, so you can see that we have penalties, which is based on what? Employee headcount. So let's talk a little bit about that.
Thanks, Dan. Just to remind everyone, a mid-size employer has 50 to 99 full-time and full-time equivalent employees. A large employer has 100 or more full-time and full-time equivalent employees. And specifically, full-time and full-time equivalent employees can include contractors, seasonal and leased employees, as well as part-time employees. One thing that I want to point out on the side is that I have had some nonprofits. I've worked with a lot of nonprofits, and they have gone international. They have locations abroad. And so one of the questions that we do get asked is, does the Affordable Care Act apply to their Americans that work abroad? And the answer is yes. So when you're calculating your full-time headcount, you calculate all of your employees, no matter where they're located, especially if they're American citizens. Again, most of the final regs were released earlier this year, so I'm sure you're wondering if there's any more transitional relief, and the good news is there is. So in preparing for 2015, employers can determine whether they have at least 100 full-time employees in 2014 by reference to a period of at least 6 consecutive months, which is down from the 12 months that it was originally.
Yeah, so in the future, you're going to look back to the prior 12 months to determine whether or not you're a large employer. In fact, for 2015, you can still do that. But you do have, under the transitional relief, the option to use any consecutive 6 months. So it doesn't have to be, July to December. It could be February to July, or any 6-month period that you pick. It just has to be consecutive. So that actually gives people a better chance of not falling under the large employer count, because you can actually somewhat mitigate that.
Exactly. And employers with plan years that don't start on January 1st can begin compliance with the pay or play provision at the start of their plan years in 2015. The requirement to offer coverage to full-time employees, dependents, again, under 26 years of age, so basically 25 years or younger, will not apply in 2015 if an employer is taking steps to arrange for such coverage in 2016. Please note, though, however, that the IRS has indicated it would consider whether it's necessary to extend any of the transitional relief beyond 2015. So fingers crossed, right? I know this still seems fairly complicated on how to count your full-time. So Dan, can you please help with that?
Yeah, so there's two things you have to count. One, full-time employees and full-time equivalents, and that determines whether or not you're a mid-size or large employer. And then for the penalty phase, we're going to have to count just full-time employees. But number one is let's count your number of employees to determine whether you're a large employer or not. So we really take a three-step process. And this is done monthly and then divided by your full 12 months if you're using the 12-month look back, or divided by 6 if you're falling under the transitional relief. So the first thing you do is you count your full-time employees, and that's bucket number one. And once again, as everyone answered correctly, full-time employees are those working 30 or more hours per week. So that goes in bucket number one. Bucket number two is we have to determine the full-time equivalents. So that is all your other employees that weren't full-time employees. So we add up all their numbers, add it to your full-time employees, and determine whether or not you're a large employer or not. So let's look at an example of that. Here's our facts. So we have 20 full-time employees that they're averaging at least 35 hours a week. We also then have an additional 40 employees that are not working the 30 hours per week, and in fact they average 90 hours during the month. Then there's no seasonal type employees that we get to back out of this. So that's our facts. Let's go through that calculation. Step one, the easiest one. We have 20 employees who are working 35 hours a week. So that's 20. So we put that in bucket number one, 20. Next, let's determine our full-time equivalents. So what we do with them is we take all those 40 employees, multiply it by their hours to get a total hours for the month, which in this case, because they're averaging 90 hours per month, they come up with 3,600 hours for the month. Then we divide that by 120. So 3,600 divided by 120 gives us 30. So that's bucket number two. What do? We add bucket one, bucket two, and so we have 50. You're considered to have 50 full-time employees and full-time equivalents for the large employer piece. So in this case, in 2015, you would be considered as part of that mid-size employee group, and you'd presumably qualify for the transitional relief. Coming in 2016, all of a sudden, you're going to be a large employer, assuming they don't extend the transitional relief permanently or for another year. All right, so then now we've determined whether or not you're a large employer or not. The next piece is counting your full-time employees. So now, as a large employer, you only have to offer affordable insurance to your full-time employees. Your full-time employees do not include those full-time equivalents that we just calculated. So in the last example, if this was 2016 and you're a large employer, you only have to offer coverage to those 20 employees because they're only your 20 full-time employees. So how do we count them? There's actually two methods. One is a monthly method that you're just calculating each month. And the other method, which I think more people will end up using, is our look-back method. And the look-back method is easier in that you know each month who your full-time employees are going to be. And it's really a three-step process. One, we have what's called a measurement period. which is followed by an administrative period, and then we end up with a stability period. And this is something that's always rolling. And you can actually choose your measurement period to be from 3 to 12 months. So it gives you some strategic counting possibilities there. So what happens is, during your measurement period, you're going to count your full-time employees. So during that measurement period, and you count the employees, and then directly following that, you have an optional administrative period, which, even though it's optional, I think most people will do it, because what happens is it'll allow you to change your plan during that administrative period to comply with the insurance mandate. Then we fall into what's called the stability period. And the stability period is the period in which the employees that you determine were full-time or part-time during the measurement period are going to continue to be full-time or part-time during that stability period, whether or not they work 10 hours or 100 hours during that stability period. So you get to mark them in the measurement period, and you know that during the stability period, they're full-time or part-time. Now, since this is a rolling test, if they change their hours during that stability period, then during the next measurement period, they'd be counted again differently, and then in the future, they'd change either full-time or part-time. So it's a pretty involved calculation. There's even more nuances where you can choose different categories of employees to count. So there's really an opportunity there that you need good software to actually do the counting and reporting of this. One thing to note is that 2014, although there's no insurance mandate, it's a good chance to practice to make sure you have all your ducks in a row, so that you're not going to be all of a sudden in 2015 just scrambling around and panicking. So that's when the actual penalties will take place. All right, so what happens with the IRS? You file tax returns. Everyone out there files their individual return or nonprofit 990s, and we have to report to the IRS. So let's talk about the reporting requirements. So how are these things going to be reported, and why? Well, obviously, the IRS in everything makes you self-report things. So they need to hear from you whether or not you're qualifying under the mandate exceptions. So they need you to report all the information necessary for them to determine whether or not you're subject to the insurance mandate. And that's going to take the form of a yearly reporting. And you'll find out as we talk about this that the yearly reporting is going to be very similar to 1099s that you issue. So if you're familiar with 1099s, at least from a knowledge standpoint, you'll be able to handle these new reporting forms, which are going to be 1094 and 1095Cs. Now, these aren't out yet, so I haven't seen what they look like, but we know it's going to have to go on them. So let's talk about a little bit about what goes on them. So since the IRS needs this information in order to determine whether or not you're falling under their mandate, they need all those pieces to determine that. So what's going on in this? As a large employer, you're going to have to report, one, all your full-time employees, their name, address, federal ID number, whether or not you offered coverage to them, whether it was affordable, and whether it met the minimum values that are needed. I'll also point out that the mid-size employees or mid-size employers are also required to do this reporting, although under the transitional relief, they're not going to be subject to the insurance mandate penalties. Also, this is going to be yearly reporting, but you're going to have to report monthly information. So you're going to have to be able to capture all this information on a monthly basis. So if your full-time employees are changing, you're going to have different reporting requirements. Under the transitional relief, they did give you some simplified reporting options, and you can qualify for that for making what's called a qualifying offer to your employees. And there's two pieces there. One, there's qualifying offers to each individual employee, and two, there's making a qualifying offer to at least 95% of your workforce. That transitions next year to 98% of your workforce. But what is a qualifying offer? A qualifying offer is essentially an affordability offer of insurance that meets the minimum insurance benefit requirement, and that's going to be based on the poverty level. So in this case, if you offer to your employee or employees affordability of $1,100, then that's going to be considered a qualifying offer, and it has to be for the entire year. If you meet that requirement, then you don't have to do the monthly reporting. You just have to put the employee's name, address, and ID number. So that's a pretty good simplified reporting. And if you actually do that for 95% of your workforce, then you can actually do the reporting for your entire workforce. And now what will happen there, as long as you made that qualifying offer to the workforce, there's going to be a box to check that you certified you made these qualifying offers and that it was to your entire workforce. And then you don't have all the monthly reporting requirements. I'm not sure how often that's going to take place. It might be a little hard to do that qualifying offer, but if you do, you're going to have that reduced reporting. All right, let's talk about the deadlines. So there's two reporting requirements. There's one for healthcare insurers and self-employed employers, and then there's the reporting for your mid-size and large employers. Luckily, these two can now be combined into one form, whereas before this transitional relief, you were potentially having to do multiple reportings. So what are the due dates? These are exactly the same as your 1099 reporting. So by January 31st, you have to send these forms out to your employees. Then the government reporting happens if you're a paper filer on February 28th. And if you're using the electronic filing method, that switches to March 31st. Note that some employers are required to electronic file, and that's if you have 250 more reports. The report is essentially each individual employee. Okay, that's a lot to chew on, but let's go to our fourth and final polling question.
Thank you, Dan. So our final polling question, if you haven't answered one, answer this one, right? 75% of questions have to be answered for CE credit. And a reminder again that I will be sending out the presentation after the webinar. So what size employer is your nonprofit? Are you A, do you have between 1 and 49 full-time employees? B, between 50 and 99 employees? C, between 100 and 149 full-time employees? Or D, between 150 or more employees? Or are you just not sure? And then E. So we'll give you a few seconds to log your answers. And we'll close the poll in 3, 2, and 1. And I'll turn it over to Susan.
Okay, thank you, Debbie. So based on everybody's answer, to the polling questions, it sounds like this next page will apply to everyone. So let's take a moment to review steps we should be taking now to prepare for the Affordable Care Act. We should understand the new requirements to comply before January 1st, 2015, which you all have done as you are attending today's webinar, so congratulations. Remember that there are things that need to be done now, especially for mid-sized employers. You do have things in 2014 that should have already taken place. Next, please determine whether you are a mid-sized or large employer, especially since, as mentioned, these two groups have been divided and the requirements are now a bit different. Plan to have a reporting system in place and, of course, consult your tax advisor. In terms of calculating your headcount, Armanino does offer a couple different options, so we make it easy for you, so no worries. Armanino will provide an employer with their employee headcount calculations and the proper reporting documentations to meet IRS requirements. Specifically, we will determine if you qualify as a mid-sized employer or a large employer, which will determine what transitional relief you qualify for. We will calculate your full-time and full-time equivalent employee headcount, help certify that your nonprofit meets new IRS information reporting requirements, and evaluate potential tax penalties. We're going to help explain and navigate through the changing Affordable Care Act regulations, and Lord knows they keep changing, it seems like quite frequently. And we will provide you with a report that you will be able to show to the IRS, verifying how the headcount calculations were determined. And this is really important because it will be a CPA that has gone through everything, looked it over, signed off on it, and you will be able to show the IRS you did your due diligence in good faith, you did everything you were supposed to, what else could you have done, right? And importantly, the Armanino headcount calculator uses existing employee data, so there's nothing extra really you need to provide us with. So we'll just calculate from either your payroll. So let's say you have Paychex or ADP or something like that. We'll plug that information in, and we are able to determine the optimal look-back period for employers to potentially minimize their health care benefits and or tax penalty liabilities, which is huge. We have, for some people, reduced their overall full-time headcount based on strategically picking their measurement period. And so their tax liability has been reduced. In short, option 1 is we will run the calculation for you. Option 2 is you will do the calculations yourself because you will have our software. Or option 3 is we will do a combination of both. You will have access to the Armanino software tool, and you will also have access to a tax partner to verify what you did and the accuracy of it. So we definitely have something for everyone. Debbie, I'm going to turn it back over to you to close it out and see what questions we have.
Thanks, Susan. So just a brief wrap-up. Today during the webinar, we've covered a brief history of the Affordable Care Act. We've reviewed what are the qualifications for becoming a mid-sized employer for the transitional relief, who then is a large employer during the transitional relief. We've looked at how you can calculate your headcount. And we've also looked at simplified reporting requirements and, thanks to Susan, the steps that you can take now and the tools available to you to really start getting in compliance and getting with the Affordable Care Act. So with that, we do have about 10 minutes or so to answer some questions, and we've got some here. So I will turn it over to Dan.
Thank you. So yeah, we do have a couple questions. I'll start with one of the easier ones here. There was a question in calculating full-time equivalents of why you divide by 120 and coming up with your full-time equivalent. The reason you divide by 120 is essentially that is 30 hours per week times 4 for a monthly total. So that's 120 hours. So they're just using an average of 30 hours a week, 4 weeks to come up with the 120. So it's just by rule that you do that, and it makes logical sense there. So that's the reason for the 120. Let's see. Here's a pretty good question. So somebody has a lot of volunteers, and the question is, some of these people work a lot of hours. Are they calculated in a head count? And the answer to that is no. As long as you're a volunteer, and you're just doing volunteer hours, then your hours as a volunteer are not included in any of these counts. So that would be, a pretty rough thing, because a lot of nonprofits, I know, require a lot of volunteer work. And if you were subject to having to pay for insurance for those people, that would be a big hardship on the nonprofits, who a lot of you are skimping and scraping for every donation dollar you can get. That actually brings me up to another point that I think I'll bring up, is that there's some employees that are exempted from counting. And one of those is for our religious organizations. If you have someone who's under a vow of poverty, then you don't have to count their hours, as long as they're performing services that someone generally under a vow of poverty would take. So that's a pretty good benefit there, because usually those orders don't necessarily have a lot of money to pay for health insurance. Another group like that are teachers. You have summer vacation. So what happens there? All of a sudden, are you counting employees that they get dinged for taking summer vacation when the schools are shut down for teachers? And the answer is no. You ignore summer vacation for teachers, and that's just part of their normal working hours. You don't take that into account when counting up these employees. And there's a couple questions about foreign reporting that are a little more complicated, I think, and we need a little more facts. So what we'll do with those questions is we'll reach out to you. So if you give us your email, we'll need to get a couple more facts, and we'll get to you after the webinar is concluded. All right, here's a question. The question is, when talking about offering insurance to 95%, is it the entire workforce or just those with more than 30 hours a week? So the answer to that question is, it's only the full-time employees. So it's only the 30 hours or more a week people. And for the transitional relief, as you recall, for 2015, that's going to be 70%. So the only time your non-full-time employees come into count is when you are determining whether or not you're a large employer or not. But for all the mandate laws, it's just full-time employees. Okay, another question. Do you have an example of someone close to qualifying as a small employer that we've helped remove? Right now, because it's been transitioned, we haven't had to actually treat someone as a small employer. But we do have an example of one client that's actually a nonprofit that have thousands of employees, but they're all part-time. So it's interesting that they qualify as a large employer, but because all these part-time employees are working under 30 hours a week, they actually end up with no actual full-time employees. So even though they're a large employer, they're not going to be subject to any of the penalties. Now, if you're really close to the 50 employees, there are different strategies there. One, you can look at the 6-month counting. So you can try to pick a different 6-month time frame to get that under the 50. Or, some people just are looking at laying off people. So it's really a entity versus entity problem, because there's different cultures. I mean, your culture may be that, you're not ever reducing headcount, and that's just something you can't do. So then, we look at different ways to minimize insurance in that case. Or you're just a ruthless nonprofit, and you're going to cut people, to get under that 50 employee limit. And there's always somewhere in between. So what you want to do is consult with either someone like us or in conjunction with your insurance brokers to try to come up with the best answer. There's a question, why am I skeptical that organizations would be able to meet the 95% test for simplified reporting? I'm just not sure it'd be that useful in that how many people are going to actually offer that type of insurance for a 12-month period. It just doesn't give you a lot of, you have to offer it for that full 12-month period to all the employees. I'm not sure how many plans allow you to do that. That's all that I'm skeptical on. But it's certainly, if that's how your insurance is, then by all means, you qualify under that simplified reporting. Okay, so the question, in 2016, if 95% of the full-time employees are covered, if any of the 5% go to the exchange, is the employer penalized? So that's really a two-part question. First part is, you're not going to be penalized for not offering insurance. Since you've offered at least 95% of insurance to your full-time employees, even if the 5% who you didn't offer it to go and they go to the exchange and they qualify for one of the subsidies, you're not going to be penalized under the not offering insurance. Now, where you could get stuck is the reason they're going to the exchange is maybe it wasn't affordable for them. So for that 5%, you are potentially subject to the penalty for not offering affordable insurance. So that's generally going to be a smaller penalty, but you would be subject to that penalty. One thing to note that I forgot to bring up as well is that you're going to start getting notices of your employees that have actually gone to the exchange and received a subsidy. And because it's not during the insurance mandate period, because it's been delayed, it actually gives you a big opportunity for a couple things. One, if you are offering them affordable insurance, they've done something wrong, you want to correct that now, because one, your employees will probably get penalized for not having, they'll get penalized because they've taken a subsidy credit that they really shouldn't have. Two, if you aren't offering affordable coverage, it really gives you an idea of how many of those employees are going to really cause you to be penalized, because I have 10 employees that have gone to the exchange and they have got the subsidy, so they're going to cause me to have penalty. Well, it looks like I'm getting the hook here. So we'll go ahead and wrap it up. And like I said, for the people that have more questions, we'll get back to you after the webinar, particularly the ones with the foreign reporting questions. Thank you very much.
Thank you so much for joining us.
Thank you all. And again, we'll be sending out the slides for your download after the presentation. And for those with CE credit, please respond to the survey at the end of the webinar, and you should be receiving your certificate within 3 business days. Thanks so much, and we hope you join us for a future webinar.